What I would say, and what's consistent with what we talked about during the earnings call, is that we think we're going to be driving towards a 30% incremental EBITDA margin, in 2023 and beyond, because we think that that's the right level of investment that will enable us to drive top-line growth for decades to come.
SoFi CEO Anthony Noto and SoFi CFO Chris Lapointe have just exposed their ambitious plans for SoFi and recently discussed their long-term goals for profitability. There have been two very important events that have happened this month that have given us a peek into what to expect from SoFi in 2023 and also the years to come. On June 9, 2022, Chris Lapointe attended the Piper Sandler Global Exchange and FinTech Conference, where he discussed some important keynotes on where SoFi is right now and where it's heading. On June 15, 2022, Anthony Noto also participated in an event called Morgan Stanley US Financials, Payments, and CRE Conference. During their discussion, he expressed some interesting points on the controversial reverse stock split and what lies ahead of SoFi in the second quarter of 2022. In this video, we've combed through all the footage of both events and summed them up to the 6 most important things that were discussed and that you should be excited for if you're a long-term SoFi investor. We'll discuss the student loan moratorium, interest rate, an update on SoFi Bank, SoFi's new feature, SoFi's profitability, and so much more. If you got a chance to tune into one event, both events, or haven't watched either event, make sure to watch until the end of this video, as we'll be covering the most important things they've discussed and things you may have missed. You don't want to miss any of this. We're not financial advisors, and none of this is financial advice, so always do your own due diligence, or as we like to call it, do. If you haven't already, make sure to follow us on our social media pages at Wealth Gambit. We'll put the link in the description box below. And now, without further ado,
let's get started.
Number 1, student loan moratorium. After the announcement of the student loan moratorium extension last April 6, 2022, SoFi stock, along with other fintech companies, took a free fall. Since then, its stock price has stayed in the range of $5 to $7 per share at the time of recording this. But how does this exactly affect SoFi's lending business? And if the student loan moratorium expires, would this mean a tailwind to SoFi's lending business? Here's SoFi CFO Chris Lapointe's answer to that.
Yeah, so as you mentioned, what's baked into our overall 2022 guidance is that the moratorium does not expire and it extends throughout the rest of the year. We don't have any expectations for when it's actually going to expire. It's an evolving situation with new news and hypotheses every single day. So I don't want to comment on where we think that will go, but it will certainly, when and if it does expire, it will certainly be a tailwind to the business. What I would say, and what's consistent with what we talked about during the earnings call, is that we think we're going to be driving towards a 30% incremental EBITDA margin, in 2023 and beyond, because we think that that's the right level of investment that will enable us to drive top-line growth for decades to come.
Number 2, SoFi's adjustment to a higher interest rate environment. Another thing that's causing negative sentiment toward the market is the Fed's multiple interest rate hikes. Now, it's only fair to say that this is one of the huge reasons why SoFi's stock price has been staying at its lows in the past months. But have you ever wondered how this higher interest rate environment affects SoFi as a whole?
Yeah, absolutely. So what I would say in terms of the overall student loan market is there's about $1.7 trillion of debt outstanding today, with hundreds of billions of dollars of debt outstanding that's priced at a level that's far north of where we're able to price our student loan refinancings right now. And that's primarily a result of two things. We have a cost structural advantage as a result of being vertically integrated and being able to offer better pricing relative to some of our monoline peers. And then second, by now having SoFi Bank, we're able to further strengthen that structural advantage that we have.
Here's SoFi CEO Anthony Noto on how they have been adjusting to the high interest rate environment.
What are you saying?
Yeah. So in 2018, when we set the objective of hitting a 40 to 50% variable profit margin per loan, we had to develop a lot of testing capability. One thing that we developed was the ability to test pricing and credit. And we have about 6 different grids with 36 cells in each grid that we're constantly testing each week to see how far we can push WAC versus credit and where we would be on a loss basis. And we've been able to pass on a lot of the increase in benchmark rates. I would say the last 2 weeks, we're just adjusting to now, but prior to the last 2 weeks, we were passing on about 70% of the increase in benchmark rates in a higher WAC in our unsecured products. which is a testament to our testing capability, but also the differentiation in our product in terms of our ability to find the right customer with the right credit profile at the right price. And we've maintained, as you imagine, we're looking at elasticities as we raise price, and we maintained what we thought we would want to see in the quarter.
So 70%, I think.
Real quick, if you've made it this far in the video and you're still holding SoFi, comment "still in the trenches" down below to be shouted out in an up and coming video. Number 3, new feature in the SoFi stock. Commander Noto was asked about their growth ambition for SoFi and what lies ahead in the second half of 2022. And Noto revealed that there will be a new feature in the SoFi app called SoFi Plus, not to be confused with Hulu Plus. At the time of recording this, it's entirely free as long as you make direct deposits with them.
And you'll see us launch something called SoFi Plus, which brings everything together. SoFi Plus will be like a subscription service where you get a whole host of member benefits if you do direct deposit with us. So we won't charge for it, but we'll give you all these value-added services when you do SoFi Plus with us, which is triggered off of doing direct deposit. And there'll be benefits in loans, benefits in invest, benefits in rewards, and a number of other areas. So that will bring it together as well.
And when can we expect that to come out?
That's a back half of this year type of initiative, and one that we think communicates a couple things. First, it says, hey, this is a one-stop shop. They have a product across all these different areas. I only have to do one thing to get the benefits across all these areas. And it'll be something we add more value to over time as we learn and grow. As an example, today we double your points if you redeem into other products. You could imagine a SoFi Plus member getting triple their points or quadruple the points for a specific activity, and many other iterations around that. But we want to get the platform launched, learn, and iterate as we go.
Have you figured out what kind of pricing you'd like to do on that product? Or?
SoFi Plus will be free if you do direct deposit. At some point, we may provide the opportunity to pay for it instead of doing direct deposit, but we love direct deposit customers given all the benefits we get from the data and helping them get their money right.
Number 4, reverse stock split. Now, for the controversial proposal of a reverse stock split at the 2022 SoFi annual shareholders meeting, Commander Noto was asked about this proposal. This was his answer to that.
There's been a lot of chatter on all the social media platforms, which we read, and we care about all of our shareholders deeply. And this is definitely one that's created a lot of controversy. The headline, I would say, is this is one of those break in case of an emergency. And I've lived through the financial crisis of 2000, 2001, 2002, the crisis in 2008, 9, and 10, and obviously we're going through a huge dislocation now. And so as we were going into the shareholder meeting, we thought about all the ranges of scenarios that could unfold and what do we need to be best prepared. And markets can be irrational. Like, we're incredibly proud of what we built. We think we have a durable business. It's doing quite well. We're one of the few companies that exceeded Q1 expectations and raised for the rest of the year. So our confidence is in no way reflected in the ask for this vote. What is reflected in the ask for this vote is prudent management. We want to give our board the option that if we enter a market that's even more irrational than we are now, and it is justified to do a reverse stock split, they have the option to do it. Many shareholders don't realize that to do a reverse stock split requires a shareholder vote. And if you don't ask in your annual shareholder meeting, and for some reason you need it down the road because the markets are irrational in our case, which would be the only scenario that I see us having to do it, unless there's something I haven't anticipated, the board has the optionality to do that. Otherwise, we'd have to have a shareholder vote on one particular thing at a high point of stress when the markets are irrational and may not be able to help the company. So it's really meant to be a free option for the board if they believe they have to break in case of an emergency. But it in no way communicates our confidence in our strategy, our business, or what we see in the future. Our goal is to keep driving our results, which eventually will be reflected in our stock price. But we're right now in a period of great uncertainty, and people don't know answers to some questions. But I know our strategy is the right one, we have the right team, and we're executing.
The approval of the power to issue a reverse stock split vested in the board of directors isn't something they'll implement as soon as they get approval. As Commander Noto said, it will function as a break in case of emergency. Number 5, SoFi Bank update. It's been half a year since SoFi got its bank charter approval. If you're wondering how it's doing, Chris Lapointe has given some interesting updates.
Yeah, we've seen a tremendous uptick in our overall deposit base, and we're really happy with the progress that we've been making there. So when we announced earnings a month ago, we had said that we were at about $1.5 billion of deposits and growing at around $100 million per week. This week, we're at about $2.2 billion of deposits right now at SoFi Bank, and we're still growing at that healthy clip of north of $100 million a week. So overall, really good progress. That's a really key element of our overall longer-term strategy. And we're also really happy with the progress that we've made on the direct deposit side. We've seen a significant uptick in terms of overall conversion. Our conversion rates for our direct deposit members have increased by 60% Q1 versus Q4. The overall average balance per direct deposit member has increased about 25% sequentially. And then we're seeing really good engagement trends where spend per money member or checking and savings member has increased as well sequentially.
That's true.
Number 6, SoFi's profitability. And for the most important point, Commander Noto and SoFi CFO Chris Lapointe were both asked about SoFi's profitability. Chris was asked why they expect profitability on the back end of the second half of this year, and this is what he had to say.
This year.
Yeah, two main things are driving that. First is we do expect to see continued growth in our high margin personal loans business, which has been doing extremely well in a rising rate environment as people are looking to refi out of variable rate debt into fixed rate loans. So that business continues to do extremely well. We expect it to continue to do really well, and it has high margins. Similarly, on our Galileo business, which has high margins, 30%, right now we expect to see continued and sustained growth throughout the rest of the year. The second main component and one of the larger drivers is the fact that we now have access to the bank and a lower cost of capital. So in the back half of the year, you're going to start seeing a much more meaningful impact from the lower cost of capital of using our now high quality deposits that we've been able to raise through SoFi Bank, as well as an extended hold period. So prior to having the bank, we would originate a loan, hold it on our balance sheet for 3 months, and then sell. Now that we have a bank, we have the flexibility to originate the loan, hold it on our balance sheet for up to 5 to 6 months, and then sell. And we're seeing incremental gains on net interest income, which will be a large driver of that ramp in the back half of the year. But we're also not seeing any degradation in our gain on sale margins.
And Commander Noto was asked about SoFi's profitability as a whole.
Over time?
Sure. When we set the objective of having a 30% incremental EBITDA margin, we did that so that we could answer this question when times get tough, the same way we answer it when the market's very jubilant. We didn't reinvest everything when the market was jubilant because we have to show a path towards long-term margins, which on an EBITDA basis we think are over 30%. So when we established 30% incremental EBITDA margin, reinvesting 70%, it was to reinforce where our long-term margins were going to be, as well as our long-term ROE and ROA. This year's a little bit of an aberration with the student loan refinancing moratorium being extended, but that's sort of our path long-term. Let me talk about each of the pieces. So our lending business is very profitable. We disclosed the contribution profit there. I wouldn't expect that margin to go up very meaningfully. There's a couple sources of upward margin expansion there, but we'd likely reinvest it over time. So student loans is operating at less than 50%. We've talked about that in the past. So that margin gets negatively impacted by that environment. Personal loans, very high margin at really high volumes. I wouldn't expect the margin to go higher there because we want to maximize dollars in that range of 40 to 50%. Home loans are definitely under earning relative to where they could be long term as we're retooling the back end operation there for purchases versus refinance loans. So I would say the contribution profit margin for lending is probably at steady state already with some pluses and minuses depending on the environment. The technology services business is about a 30% EBITDA contribution margin. That was 40 to 45% when we first bought Galileo, but we've invested massively in moving to the cloud and a bunch of new products that we want to sell to existing customers. And so the revenue streams against that investment will come down the line. So that margin over time would go from 30 to 40+%, but in the near term, we've said keep it at 30 because we want to invest in future growth of those new products, but more upside there. As it relates to the financial services business, that's the area where we have the most margin expansion. If you go through our Qs and Ks, you can now calculate the revenue for that segment less all the variable costs. If you subtract all the variable costs except marketing, you'll see we've been profitable, revenue less those variable costs, for the last 3 quarters. If you then add marketing expenses, we'll cover the marketing expense in addition to the other variable costs by the 4th quarter of this year. So the end of this year, our variable profit in financial services will be positive after marketing, and that includes acquisition costs within marketing. And then by the end of 2023, it'll cover our fixed costs. And then the last piece we have to cover is our SP, stock-based compensation. That currently is very high. If you sort of adjust it for the one-time grant of the PSUs, it was around 15 to 16% of revenue in Q1. We expect that to get down to the high single digits by 2024, and that's when we'll bring all the pieces together for GAAP profitability. We grow faster. If the student loan business comes back faster and is bigger, the home loan business gets to where we want it to go, that path could change. There's other revenue streams that we have that we're not counting on in a 5-year forecast that are tied to the bank, as well as our technology platform business. So lots of opportunity for new products that we're not factoring into the outlook for technology.
Well, there you have it, ladies and gents. It looks like SoFi has some big plans and investors have some positive things to look forward to in the up and coming years. Shout out to all of you who commented SoFi Russell 3000 in one of our videos. We greatly appreciate your support. A special shout out to everyone in our Patreon community. You guys truly help to make these videos possible, and we really appreciate all the support. Shout out to Arthur Magazu, Wei Chu, Daniel Corbett, Mr. Welfare, Casey Patel, Jeff Sherman, Gregory Villar, Bo Park, Denzil, Reginald Davis, Les Broadway, Christian Cardelphi, Kevin Beaufran, Jay Bone, Daniel Zintson, and ABC Sam. That's it for today's video. Thanks for watching. We greatly appreciate it. Until next time. Peace.